Hi, I'm Christina Nalia with the Nalia Garami Real Estate Group. We've been seeing more and more difficulties with mortgages and financing than ever before. So we decided to go to an expert to answer all your questions.
Hi, I'm Laurie Furness. I'm a mortgage agent with Mortgage Center Canada, and I have been in the industry for well over 25 years, mostly in the Oakville area. The benefit of being a mortgage agent is the fact that I can deal with the different lenders, so I can make sure I can tailor the mortgage product to the client's specific needs. Every lender won't do every deal, and my role is to ensure I educate the consumer as to the best product for them specifically. Difficult to indicate financing guidelines, but as an overview, if you are purchasing up to $999,999, you can put less than 20% as a down payment. Over the $1 million, 20% is minimum, and then the lenders also have a sliding scale. What that means is they will lend 80% of the first million, 1.2 million, 1.5 million, depending on the institution, and over that you have to put 35 to 50% down. So depends on the institution and where you're buying. Those numbers are based on the GTA. We have had a number of changes over the last 5 or 10 years, but the major one that happened at the end of last year and was implemented the beginning of 2018 was B20. And the most important piece of that was the pricing for the lenders. They now have to keep a certain amount of capital on their books, and they also used to be able to bulk insure, which they no longer can. What that meant to the consumer is no longer could they insure a refinance or an investment property, which now meant those products were no longer available with certain lenders, or they now have a higher interest rate. So if you have 20% down now, you are actually more expensive to the bank than someone with 5% down. Therefore, if I put 5% down, I'm getting a better rate than someone with 50% down. So the mortgage stress test, that's part of B20, and what that is the minimum rate that we have to use for a high ratio mortgage is 5.34%. That is what's called the benchmark rate, and you can find that online. If you are conventional and you have 20% down, then I have to add 2% to the contract rate that you're getting. If that rate is lower than 5.34, 534 is the minimum I will have to use when working out the ratios for qualification. Some clients get confused. It's not the rate they're getting, it's just the rate that we're working the ratios out at. That could be a number of reasons, but one of them is if individuals are going directly to the bank, some lenders just say, well, how much is your income? What are your outside debts? What do you have for down payment? But they aren't actually doing a full pre-approval, meaning they're not checking credit, they're not getting income verification up front. The problem with that is credit at this point is imperative, and depending what your beacon score is will dictate whether you can get financing, whether we can get exceptions to ratios, and or what your rate would be. So the credit is extremely important, and you know, some people will put in their income. It might include a bonus or overtime, which we are not able to use unless there's a 2-year history. The other thing that could very well be an issue is if someone is selling who owned a couple of years ago, they would have been qualified at the rate they were getting. And last summer, our rates were 2.5% for a 5-year term. Today, I'm having to qualify that client at 6%. It is a dramatic difference in what they can qualify for. Well, the stress test is causing it difficulty with qualification, and so is credit, and more so for individuals looking to refinance. They may have some bruised credit if they have been increasing their debt load, and at that point, we don't want to lose the first mortgage rate if they aren't able to qualify to refinance and increase and blend it. So that is one instance where we'll go with a second mortgage. So they are becoming more and more, I hate to say popular now, but they are more of a requirement. And there are individual seconds that I could lend my RSP money to someone, or it could be through what's called a mortgage investment court, where it's a pool of funds that is lent out to individuals for second mortgages. The Mortgage Investment Corp is also there for individuals who cannot qualify because of the stress testing. The issue with that is we're afraid after a year or two, if they don't qualify now, they may not be able to qualify to get out for a better interest rate. So just as a reminder, the benefit of a broker is that we have a number of institutions available. So it could be from a bank to what we call monoline lenders that are not one of the 6 major banks, to private mortgages, to B lenders, etc. But the main thing is the education. You don't know what you don't know. And if you don't know what to ask the lender, they are not going to be forthcoming with you, because let's face it, there's pros and cons to every deal or every product, and they're going to give you the pros and maybe not the cons unless you know to ask. So that's what my role is, to make sure you understand the product, the pros, the cons of the policy, so that you can make an informed decision as to what is best for you. There is no fee to deal with me. I'm paid by the lender, which allows me to be impartial when recommending one institution over another.
A big thanks to Laurie Furness for taking the time to film with us. It was so insightful.